Hello, and welcome back to Boni's Life, your home for insightful analysis that cuts through the noise of the financial markets. Today, we're diving deep into a topic that's been on every investor's mind. The latest earnings announcements from the 10 most valuable companies in the world. These are the titans of the global economy, the companies that don't just follow trends, they create them, and their recent performance reports have sent ripples across the entire market. Now, I know what you're thinking. Boni, earnings reports? Isn't that just a bunch of boring numbers and corporate jargon? And you're not entirely wrong. It can be. But here at Boni's Life, we do things a little differently. We're going to dissect these numbers, peel back the layers of corporate speak, and uncover the hidden stories that these earnings reports are telling us. We'll explore what these results mean for the future of these companies, the broader market, and most importantly, for your investment portfolio. We're not just reading the news, we're reading between the lines. So grab your coffee, get comfortable, and let's get started on this journey to financial enlightenment. It's going to be an exciting ride. All right, let's kick things off with the undisputed champion of the market right now, Nvidia. If the stock market were a heavyweight boxing match, Nvidia would be the reigning champ, knocking out expectations quarter after quarter. With a market cap that has soared to a mind-boggling $4.4 trillion, Nvidia has become the poster child of the AI revolution. For those of you who've been following, you know that their graphics processing units, or GPUs, are the engines powering the artificial intelligence boom. It's like they're selling the picks and shovels in a gold rush. And believe me, it's a gold rush of epic proportions. So, what did their latest earnings report tell us? Well, in short, the party is still going strong. Nvidia reported revenue of $165.2 billion, trailing 12 months, a figure that would make most countries' GDP blush. Their gross profit is an equally staggering $115.4 billion. But here's the kicker, a 5-year annualized return of nearly 72%. Let that sink in for a moment. If you had invested in Nvidia 5 years ago, you'd be sitting on some very, very pretty returns. It's the kind of performance that turns savvy investors into legends at their family gatherings. You know, the I told you so moments we all secretly crave. But what's driving this incredible growth? It's all about AI. The demand for their H100 and now the new H200 GPUs is simply off the charts. These aren't your average graphics cards for playing video games. Though they are great for that too, these are the supercomputers that are training the next generation of AI models, from ChatGPT to advanced drug discovery algorithms. And with their recent announcement of a $100 billion investment in OpenAI and a $5 billion stake in Intel, Nvidia is not just a supplier. They are a key architect of the future of artificial intelligence. They are not just playing the game, they're creating the entire stadium. So, what's the takeaway for you, the investor? Nvidia's dominance in the AI chip market is undeniable, but with great power comes great scrutiny. The stock's valuation is sky high, and the question on everyone's mind is, how long can this phenomenal growth continue? We'll be keeping a close eye on the competitive landscape, but for now, Nvidia remains the undisputed king of the AI hill. Next up, we have the company that needs no introduction, the titan of tech that has defined a generation, Apple. From the sleek design of the iPhone in your pocket to the MacBook you might be watching this on, Apple's influence is everywhere. With a market capitalization of a colossal $4.1 trillion, Apple has long been a cornerstone of the modern investment portfolio. It's the company that taught us to think different, and in doing so, it has consistently delivered value to its shareholders. In their latest earnings report, Apple announced a trailing 12-month revenue of $416.2 billion and a gross profit of $195.2 billion. While these numbers are undeniably impressive, the story with Apple is a bit more nuanced than the explosive growth we see with a company like Nvidia. Apple's 5-year annualized return is a very respectable 19.20%. It's not the meteoric rise of an AI darling, but rather the steady, reliable growth of a mature tech giant. Think of it as the seasoned marathon runner, consistently pacing itself, while others might be sprinting and risking burnout. So, what's the story behind the numbers? Apple's success has always been built on a foundation of iconic products and an almost fanatical brand loyalty. The iPhone continues to be a cash cow, and the ecosystem of MacBooks, iPads, and Apple Watches keeps customers locked into their world. But the real story for Apple's future growth lies in its services division. We're talking about Apple Music, iCloud, Apple TV Plus, and the App Store. This is a recurring revenue stream that is becoming increasingly important to the company's bottom line. And let's not forget their latest foray into the world of AI with Apple Intelligence. While they might be a little late to the AI party, you can never count Apple out. They have a knack for entering a market and redefining it with a user-friendly and polished product. The takeaway for investors? Apple remains a blue-chip stock, a safe harbor in a volatile market. The key to their future growth will be their ability to innovate in the services sector and successfully integrate AI into their ecosystem. It's a story of evolution, not revolution, and for many investors, that's a very comforting thought. Now let's talk about the quiet giant in the room, a company that has been a dominant force in the tech world for decades, Microsoft. For a long time, Microsoft was seen as the reliable, perhaps slightly boring older brother of the tech family, but under the leadership of Satya Nadella, this giant has reawakened, and it is now at the forefront of the AI revolution, right alongside Nvidia and Apple. With a market cap of $3.6 trillion, Microsoft has firmly re-established itself as a tech powerhouse. Microsoft's latest earnings report is a testament to its successful transformation. The company's strategic shift to cloud computing with its Azure platform has been a game changer. Azure is the second largest cloud provider in the world, and it is growing at an astonishing rate. This, combined with their legacy software businesses like Windows and Office, creates a diversified and resilient revenue stream. The numbers speak for themselves. But the real excitement around Microsoft right now is its aggressive push into artificial intelligence. Their partnership with OpenAI, the creators of ChatGPT, has given them a significant first-mover advantage in the enterprise AI space. They are integrating AI into everything, from their Bing search engine to their Office 365 productivity suite, with a product called Microsoft 365 Copilot. This is not just a feature, it's a fundamental reimagining of how we will work in the future. It's like having a brilliant assistant by your side, helping you write emails, create presentations, and analyze data. So, what does this mean for you, the investor? Microsoft offers a unique investment proposition. It combines the stability of a mature software company with the high growth potential of an AI leader. They are not just a one-trick pony. They have a diversified business model that is not solely reliant on the AI boom. This makes them a potentially more resilient investment than some of the pure-play AI companies. The takeaway here is that Microsoft is a company that has successfully reinvented itself. They have embraced the future, and they are firing on all cylinders. It's a compelling story of a legacy company that has learned new tricks, and it's a story that investors should be paying close attention to. From the search engine that has become a verb to the video platform you are watching me on right now, our next company is an integral part of our digital lives. Alphabet, the parent company of Google. With a market capitalization of $3.9 trillion, Alphabet is a tech behemoth, with its tentacles in everything from search and advertising to cloud computing and autonomous driving. It's the digital librarian of the world, and its influence on the flow of information is unparalleled. Alphabet's latest earnings report paints a picture of a company in transition. For years, their bread and butter has been digital advertising, a market they dominate with an iron fist. This advertising revenue generated from Google Search and YouTube continues to be a massive cash cow. However, the company is facing increasing competition in the advertising space, and there are concerns about the long-term growth prospects of this core business. This is where their other bets come into play. Google Cloud is a key growth driver for the company, and they are investing heavily to compete with Amazon's AWS and Microsoft's Azure. It's a classic case of a company using the profits from its established business to fund its next chapter of growth. But the most exciting part of the Alphabet story is their work in artificial intelligence. Google has been a pioneer in AI research for years, and their DeepMind division is responsible for some of the most significant breakthroughs in the field. They are now in a race to commercialize this research and integrate it into their products. We're seeing this with their new AI-powered search results and their own large language model, Gemini. The battle for AI supremacy is a three-horse race between Google, Microsoft, and a few other key players, and the outcome of this race will have a profound impact on the future of the tech industry. For investors, Alphabet presents a fascinating opportunity. It's a company with a dominant core business that is also making significant investments in the future of technology. The key question is whether their AI and cloud businesses can grow fast enough to offset any potential slowdown in their advertising business. It's a high-stakes game, but with their deep pockets and world-class talent, you'd be a fool to bet against them. Let's move on to the company that has fundamentally changed the way we shop, read, and even watch television: Amazon. From a humble online bookstore, Amazon has grown into a global empire with a market capitalization of $2.4 trillion. It's the everything store, the cloud computing behemoth, and a budding advertising giant all rolled into one. If there's a company that embodies the relentless pursuit of growth and customer obsession, it's Amazon. Amazon's latest earnings report is a story of two cities. On one hand, you have the e-commerce business, which continues to be a dominant force in retail. The convenience of Prime delivery and the sheer scale of their marketplace are hard to compete with. However, the growth in this segment has been slowing down from the breakneck pace we saw during the pandemic. It's a mature business, and the law of large numbers is starting to kick in. But then you have the other side of the story, the shining star of the Amazon empire, Amazon Web Services, AWS. AWS is the undisputed leader in cloud computing, providing the digital infrastructure for countless companies, from startups to global enterprises. It's a high-margin, high-growth business that is the primary driver of Amazon's profitability. It's the engine room that powers the entire Amazon ship, and Amazon is not stopping there. They are making significant inroads into the digital advertising market, leveraging their vast customer data to offer highly targeted ads. They are also investing heavily in artificial intelligence, both within AWS and in their consumer-facing products like Alexa. The takeaway for investors is that Amazon is a company with multiple growth engines. While the e-commerce business may be maturing, AWS continues to be a juggernaut, and their advertising and AI businesses have the potential to be the next big growth drivers. The challenge for Amazon will be to continue to innovate and stay ahead of the competition in the fast-moving cloud and AI markets. But with their customer-centric culture and their willingness to make bold long-term bets, it's a challenge they are well equipped to handle. Now, for a company that might not be a household name like the others we've discussed, but is a critical player in the technology ecosystem, Broadcom, with a market cap of $1.9 trillion, Broadcom is a semiconductor and infrastructure software giant. Think of them as the unsung heroes of the digital world, providing the essential components that make our connected lives possible. They are the architects of the digital plumbing, and their technology is in everything from your smartphone to the data centers that power the cloud. Broadcom's latest earnings report showcases the strength of their diversified business model. They have a strong foothold in the semiconductor market, providing chips for a wide range of applications, including networking, broadband, and wireless communications. This gives them a steady and predictable revenue stream. But the real story for Broadcom in recent years has been their aggressive move into infrastructure software. Their acquisition of companies like CA Technologies and Symantec has transformed them into a major player in the software world. This combination of hardware and software creates a powerful synergy, allowing them to offer integrated solutions to their customers. It's a strategy that has paid off handsomely, as evidenced by their strong financial performance. For investors, Broadcom offers a compelling value proposition. They are a mature, profitable company that pays a healthy dividend. They are not a high-growth, speculative play like some of the AI darlings, but rather a steady, reliable performer. Their diversified business model provides a degree of resilience, and their strong cash flow allows them to return value to shareholders through dividends and share buybacks. The takeaway here is that Broadcom is a company that has successfully navigated the complexities of the tech industry. They have built a diversified business that is well positioned for long-term growth. It's a reminder that you don't always have to chase the latest shiny object to find a great investment. Sometimes the most rewarding investments are the ones that are quietly building the future in the background. Our next company is one that has been on a roller coaster ride of public perception and strategic pivots. Meta Platforms. You probably know them as the company behind Facebook, Instagram, and WhatsApp. With a market capitalization of $1.6 trillion, Meta is the undisputed king of social media, connecting billions of people around the globe. But their story in recent years has been about much more than just social networking. It's been a tale of ambition, controversy, and a dramatic return to form. Just a couple of years ago, the narrative around Meta was all about the metaverse, a futuristic vision of an immersive digital world. The company even changed its name to reflect this new focus. It was a bold, multi-billion-dollar bet on the future of human interaction. However, the metaverse has been slow to materialize, and investors were getting impatient. This led to what CEO Mark Zuckerberg called the year of efficiency, a period of cost-cutting and a renewed focus on the core business. And you know what? It worked. Meta's latest earnings report shows that the advertising business is back with a vengeance. The combination of their massive user base and their sophisticated ad targeting algorithms makes them an indispensable platform for advertisers. But the story doesn't end there. While the metaverse remains a long-term project, Meta has made a significant pivot to artificial intelligence. They are investing heavily in AI to improve their content recommendations, enhance their ad targeting capabilities, and develop their own large language models. They are in a fierce competition with Google and others to be a leader in the AI space. For investors, Meta presents a complex but potentially rewarding opportunity. The core advertising business is a cash-generating machine, and the company's renewed focus on efficiency has been a welcome change. The metaverse remains a wild card, a high-risk, high-reward bet that could either be a massive success or a colossal failure. But their recent push into AI provides a more tangible and immediate growth driver. The takeaway is that Meta is a company that is not afraid to take big swings. They have proven their ability to adapt and evolve, and their latest earnings report shows that they are back on track. It's a comeback story that is still being written, and it's one that investors should be watching with great interest. Let's turn our attention to a company that is the bedrock of the entire semiconductor industry. Taiwan Semiconductor Manufacturing Company, or TSMC. While you may not see their logo on your devices, their technology is almost certainly inside them. With a market capitalization of $1.5 trillion, TSMC is the world's largest dedicated independent semiconductor foundry. They are the master craftsmen of the digital age, manufacturing the chips designed by companies like Apple, Nvidia, and Broadcom. They are the silent giant that makes the modern world tick. TSMC's latest earnings report is a reflection of the insatiable demand for advanced semiconductors. As the go-to manufacturer for the most complex and powerful chips, TSMC is at the heart of the AI revolution, the smartphone boom, and the rise of high-performance computing. Their financial performance is a direct barometer of the health of the entire tech industry. The company's commitment to cutting-edge manufacturing technology has given them a significant competitive advantage. They are the only foundry in the world capable of producing the most advanced 3-nanometer chips in high volume. This technological leadership allows them to command premium prices and maintain strong relationships with their key customers. For investors, TSMC offers a unique way to invest in the growth of the semiconductor industry without having to pick individual winners. By investing in TSMC, you are essentially betting on the continued growth of the entire tech ecosystem. They are a critical choke point in the global supply chain, and their importance is only going to increase as the world becomes more digital. However, there are risks to consider. The semiconductor industry is notoriously cyclical, and TSMC's geographic concentration in Taiwan presents a geopolitical risk that cannot be ignored. The takeaway here is that TSMC is a world-class company with a dominant market position and a critical role in the global economy. It's a company that every serious tech investor needs to understand. The rewards are potentially huge, but so are the risks. It's a high-stakes game of geopolitical chess, and TSMC is right in the middle of it. Next, we have a company that has been a true disruptor. A company that has single-handedly forced the entire automotive industry to go electric, Tesla. Led by the enigmatic and often controversial Elon Musk, Tesla has been on a mission to accelerate the world's transition to sustainable energy. With a market capitalization of $1.4 trillion, Tesla is not just a car company. It's a technology company, an energy company, and an AI company all rolled into one. Tesla's latest earnings report is a mixed bag, a reflection of the growing pains of a company that is trying to scale at an unprecedented rate. On one hand, they continue to be the dominant player in the electric vehicle market. The Model Y is the best-selling car in the world, a remarkable achievement for a company that is still relatively young. They are also making significant progress in their energy storage business, with their megapack batteries being deployed in grid-scale projects around the world. However, the company is facing increasing competition from both traditional automakers and new EV startups. This has led to a price war, which has put pressure on their profit margins. It's a classic case of a company having to balance growth and profitability. But the real wildcard for Tesla is their work in artificial intelligence and autonomous driving. Their full self-driving FSD technology is one of the most ambitious AI projects in the world. While it is still a work in progress, the potential is enormous. If they can solve the problem of autonomous driving, it would be a game changer not just for Tesla but for the entire transportation industry. They are also developing a humanoid robot, Optimus, which could have a profound impact on the future of labor. For investors, Tesla is a high-risk, high-reward proposition. It's a company with a visionary leader, a passionate fan base, and a portfolio of groundbreaking technologies. But it's also a company that is facing significant challenges, from increasing competition to the complexities of scaling a global manufacturing operation. The takeaway is that Tesla is a company that is not afraid to dream big. They are pushing the boundaries of what is possible, and they are not afraid to fail. It's a wild ride, but for those who believe in the long-term vision, it could be a very rewarding one. And finally, we come to a company that is a true outlier in this list of tech giants, Berkshire Hathaway. Led by the legendary investor Warren Buffett, Berkshire Hathaway is a diversified holding company with a market capitalization of $1.1 trillion. They are not a company that creates flashy new technologies. They are a company that invests in great businesses with enduring competitive advantages. They are the embodiment of value investing, a timeless philosophy that has stood the test of time. Berkshire Hathaway's latest earnings report is a masterclass in financial strength and diversification. Their portfolio of businesses spans a wide range of industries from insurance and railroads to utilities and consumer goods. This diversification provides a level of stability and resilience that is hard to find in the more volatile tech sector. Their insurance operations, led by Geico, are the crown jewel of the empire, providing a steady stream of cash that can be reinvested in other businesses. And their portfolio of publicly traded stocks, which includes large stakes in companies like Apple and Coca-Cola, provides another layer of diversification and growth potential. For investors, Berkshire Hathaway offers a unique opportunity to invest alongside one of the greatest investors of all time. By buying a share of Berkshire, you are essentially buying a piece of a well-diversified, professionally managed portfolio of high-quality businesses. It's a low-cost way to achieve instant diversification and to benefit from the wisdom and experience of Warren Buffett and his team. The takeaway here is that Berkshire Hathaway is a company that is built to last. They are not chasing short-term trends or speculative fads. They are focused on the long term, and they have a proven track record of creating value for their shareholders. In a world that is obsessed with the next big thing, there is something to be said for the quiet, steady, and relentless power of value investing. So there you have it, a whirlwind tour of the 10 most valuable companies in the world. From the AI-fueled frenzy of Nvidia to the steady, value-driven approach of Berkshire Hathaway, we've seen a diverse range of strategies and stories. What are the key takeaways from this deep dive? First, the dominance of the technology sector is undeniable. 8 of the top 10 companies are tech companies, and their influence on the global economy is only going to grow. Second, artificial intelligence is not just a buzzword. It's a transformative technology that is reshaping industries and creating enormous value. And third, while the tech giants may dominate the headlines, there is still a place for a diversified, value-oriented approach to investing. As you navigate the complexities of the financial markets, remember that knowledge is your most valuable asset. Don't just follow the hype. Do your own research, understand the businesses you are investing in, and always think for the long term. The world of investing can be a wild ride, but with a clear head and a disciplined approach, you can build a portfolio that will stand the test of time. Thank you for joining me on this journey through the world of high finance. I hope you found it as insightful and exciting as I did. If you enjoyed this episode, don't forget to like, subscribe, and hit that notification bell so you don't miss our next deep dive. And as always, I'd love to hear your thoughts in the comments below. What are your biggest takeaways from these earnings reports? Which of these companies are you most bullish on? Let's continue the conversation. Until next time, this is Boni signing off. Stay curious, stay informed, and happy investing.